In early 2026, global maritime trade functioned with predictable regularity. Every day, the Strait of Hormuz cleared millions of barrels of oil and shipping containers. This chart tracks global real GDP growth as it drops below the 3% trendline, settling at a forecast of 2.8% for the 2026 to 2027 window. Three systemic alarms triggered simultaneously: dollar index breaking below 100, maritime insurance premiums quadrupling, and trade uncertainty hitting record highs. The Trade Policy Uncertainty Index has spiked to 7,800. For scale, this level is more than 4 times higher than the peak of the 2020 pandemic. Standard macroeconomic models struggle to process these figures because they are not designed for a simultaneous convergence of multiple exogenous shocks. We are seeing the intersection of geopolitical inflation and fiscal exhaustion in the West, along with an unwinding global carry trade. This combination creates a stagflationary trap. This macro environment exposes the mathematical vulnerability of passive institutional strategies, specifically the 60-40 portfolio, which relies on a negative correlation between equities and bonds that no longer exists. By March 2026, commercial vessel crossings through the Strait of Hormuz have effectively stopped. This rolling chart tracks 4 primary vessel categories. Crude, container, LNG, and LPG tankers have plummeted to near zero. This represents a supply shock of 7.4 to 9.4 million barrels per day, removing 9% of global petroleum supply. Institutional analysts often assume that regional bypass pipelines can absorb this deficit. Mapping the physical infrastructure shows that the Saudi and UAE pipelines can only handle roughly 35% of the total Hormuz flow. They cannot replace the lost volume. Producers like Kuwait, Qatar, and Bahrain are 100% dependent on the strait. They have no bypass alternatives, locking their entire export capacity out of the market. To understand how this transmits to the broader economy, we have to look at how energy shocks have behaved over the last 65 years. Historical data shows a lead-lag relationship. Commodity price spikes precede shifts in U.S. CPI inflation by 6 to 18 months. We see this pattern clearly in 1973, 1980, 2008, and 2022. In every instance, the commodity spike forced a sharp rise in consumer prices. With commodities currently rising, the relatively low CPI readings of early 2026 have significant upside risk for the second half of the year. This supply shock serves as the primary driver for a sustained global stagflationary wave. The United States is entering this crisis as the primary site of Western fiscal exhaustion. While U.S. nominal GDP grew 58% over the last 5 years, the sovereign balance sheet has steadily weakened. The U.S. is currently running a budget deficit of negative 7 to 8% of GDP. This is the widest deficit in the G7. This is a structural fiscal trap, fueled by the rising cost of maintaining existing debt. Debt servicing costs reached 4.88% of GDP, exceeding national defense spending. This creates a cycle. Higher rates increase debt service, expanding the deficit, forcing more borrowing, which puts further upward pressure on rates. Americans are feeling this cost shock directly through fuel prices, with diesel and petrol costs rising sharply following the conflict. U.S. consumption is now dangerously concentrated. The top 10% of households drive roughly half of all aggregate spending. Fuel costs strip discretionary income from the bottom 80%, while the spending power of the top tier is tied to equity and crypto markets. With the fiscal buffer exhausted and the consumer base increasingly fragile, the economy has no remaining shield against further shocks. Japan is exiting its 30-year deflationary era, a shift that is resetting global liquidity. Nominal wages in Japan are growing at their fastest pace since the 1990s, while core inflation is holding near 4%. Global portfolios were built assuming permanently low Japanese rates. As the Bank of Japan begins hiking, these massive, interlocking, leveraged positions rapidly unwind. With multiple rate hikes priced in for 2026, this unwinding trade forces a liquidity squeeze on emerging markets and risk-on assets globally. At the same time, the focus on China has remained on its real estate sector collapse. But while property loans contracted, Beijing executed a quiet, massive reallocation of capital toward manufacturing and heavy industry. While real estate loans dropped by 0.85 trillion RMB, industrial sector loans surged by 2.05 trillion. This capital shift allowed China to surpass both Germany and Japan to become the world's leading exporter of passenger cars. This build-out in electric vehicles, solar, and batteries has created a massive level of structural overcapacity. China is now exporting this inventory at lower prices to clear its surplus, creating deflationary pressure that directly challenges Western manufacturing. China's energy resilience is also higher than its peers. It maintains a highly diversified oil import basket and is building more nuclear reactors than the rest of the world combined. As Western economies face inflation and a liquidity crunch, China's industrial overcapacity reduces the economic leverage the West can apply in 2026. Supply shocks, fiscal exhaustion, and tightening liquidity are colliding like tectonic plates, fracturing the traditional global market structure. The market response in early March 2026 was immediate and chaotic. Looking at the asset dashboard, MSCI World equities are down, 10-year Treasury yields are rising, gold has surged, and crude oil has spiked. The simultaneous sell-off in both equities and bonds confirms that the 60/40 portfolio can no longer provide the necessary hedge in a stagflationary environment. Passive allocation is no longer sufficient. Institutional investors must actively re-weight exposure to navigate this crossfire. A defensive strategy in fixed income requires shifting to short-duration debt to avoid the risks associated with accelerating geopolitical inflation. Gold has transitioned from an alternative asset to a mandatory core allocation of 10 to 15%. Gold is supported by a weakening dollar, currently below 100, and its role as a primary hedge against unpriced inflation risk. While the Magnificent Seven have stronger fundamentals than the 2000 tech bubble, they now represent 31% of the total U.S. market cap. This level of concentration is historically unprecedented. For investors seeking structural growth, focus shifts to the primary outlier in the global landscape, India. India's 2026 growth forecast stands at 6.8%. This is the widest growth differential against both developed and emerging market peers in India's history. The main risk to the Indian economy is oil. Every $10 increase in crude adds $15 billion to the national import bill. Managing risk in 2026 requires shifting away from passive models and reallocating capital towards structural growth outliers that remain insulated from the broader stagflationary shock.